Hey everyone, my name's Andy. My channel's Finding Value. If you like this content, hit the thumbs up button for me. Subscribe if you haven't. I don't know what you're waiting for. I've got a lot of good content coming out, a lot of good market updates. So subscribe if you haven't. This presentation is going to talk about rotation of money. And I talk a lot about ratios. And ratios is kind of how we use ratios to tell relative value. So rotation of money, some of the indicators that I watch and some of the things that I look at is to see if money's rotating in or if money's rotating out. I'm going to show you what to look for to see to give you real-time indications that money's rotating out of things. That's what this is all about here. So I go over a lot of market updates. I go over a lot of 10-year, 30-year yields. I do all these things, and I don't think I've gone back and explained it well enough to everyone why I'm doing it. So that's what this is about. It's the rotation of money. So if we look at this and we look at the rotation of money. So first I'm gonna step right back and say, ratio investing. What is it? Keep in mind that ratios tell us what is relatively cheap. So we look for undervalued sectors, and all I'm doing is in this ratio is we're evaluating money flows. And money flows to one sector drives that sector higher in valuations, and it draws from another sector. What I'm looking at is I'm looking at the undervalued sectors, the ones where the money was drawn from. They're depressed. I look at those sectors and say, yep, on a historical basis, this asset is cheap to all the other assets historically. So I want to invest here. Then I look at charts, then I look at market conditions to see if they're changing for those assets to eventually be revalued under different market conditions. So ultimately what I'm doing is I'm evaluating money flows, ultimately. Right now, commodities are cheap and money has flowed out of those assets historically. And what we're seeing is we're seeing money come back into the sector just now. Like it's just starting to happen. It's not a big retail run at it. This is still very much in the beginning of the beginnings. So we're seeing money start to flow back into this sector, and we know it's very cheap based off of the ratios. Uranium to gold ratio, oil to gold ratio, all of those metrics are cheap. So I always talk about Treasury Bonds, the 10-year Treasury bond. And I want to make this crystal clear so everyone understands on the channel what I mean and why I'm looking at it. So increasing bond yields, they mean that money is exiting bonds. It means that money is going somewhere. It's leaving bonds and going somewhere else. Now, I can't tell you exactly where it's going. I can tell you that it's leaving bonds, and then I'll look at other indicators and see if money's entering. So I don't know exactly pinpoint where it's all going, but I can tell you it's roughly going into commodities, it's roughly going into the stock market, it's roughly going into precious metals, it's roughly going into certain things. So, that's one thing I look at, and it also is an indicator, it's a leading indicator for the stock market. If bond yields are going higher, that means that people are confident and they're selling bonds because inflation's coming back. So if they have a real negative yield, what that means is you have inflation that is higher than your bond yield, a 10-year bond yield that it's paying 0.9%. If inflation's 2%, you have a negative real yield. Those people will sell their bonds, which will drive the yields higher, and they park their money somewhere else. Another thing to look at is the declining dollar. It's going to spark people who hold money to invest it in something. They don't want to lose their purchasing power. They don't want to just lose that purchasing power out of holding dollars. So what's going to happen is if we look at the declining dollar, if you have bond yields that are going higher, people are selling out of bonds, they're not going to park it in cash because what they're going to do is they're going to say, I can't leave it in cash because we have a declining dollar. So I look at the declining dollar and say, well, they're not going to keep it in dollars if we have a declining dollar. So they're going to put it somewhere else. So people are going to be looking to get a return somewhere. It's going to be a risk-on environment is what they call it. Right now we have increasing yields on bonds, which means money is exiting bonds. And we have a declining dollar, which means people will eventually put that money somewhere. And that's why I'm looking at these things. And if they're not putting it in bonds, and bonds is a very large market, and they're not going to keep it in cash, they're going to run most likely to the undervalued assets. So we look for undervaluation, and under previous conditions, like this in history, we've seen people go to precious metals, real estate, and commodities. When you have an increasing interest rate environment, you have inflation, that's typically where they go. They're going to ditch cash and bonds, and stocks are going to be somewhere in the middle. Sometimes they perform okay, sometimes they perform not very well in these market conditions. And what happens is the market conditions go from where they were today, so to speak, just before today, we'll call it, to what's just in front of us, and a revaluation occurs under these conditions. Because when you have a declining dollar, when you have inflation, and if and when interest rates go higher, bonds are going to go down, stocks are going to have a huge headwind in that scenario. Now, are we there this second? Maybe not. I don't know. I can't tell you, a month from now or 2 months from now if stocks are going to really have a tough time because there's a lot of, they're meddling around with all of these indicators. They're trying to hold interest rates down. They're trying to buy bonds. That's what QE is. They're messing with the indicators. They being the Treasury, the Federal Reserve is, not the Treasury, Federal Reserve. So, but eventually a revaluation is going to occur where stocks are going to get priced downward with bonds eventually. And you're going to see all the commodities and precious metals get repriced much higher than what they are today. So what we do, and this is what we look at, is we look at bond yields. We're seeing if they go higher. We're looking for a declining dollar, and we're looking for increasing prices in the commodities that we own, and we're looking for a compression of the ratios. That's the gold to commodity ratio and the commodity to S&P 500 ratio eventually. That's what we're going to be looking for. And another thing to look for in your investments is volume spikes in charts. Money is either flowing in or it's flowing out when you see large volume spikes at either tops or bottoms. And they usually spike up pretty good. So I'm going to show you this in some charts. This is a 10-year Treasury yield. What we're looking at is the yield. The yield is a percent. It's an interest rate. Now, you don't really need to be worried about the actual values. Really be worried about if this is declining or if it's increasing. So if it's declining, that means that people are running to bonds and they're scared of something. When it's increasing, going up like this, it means that people are gaining confidence in the economy. It means that inflation's probably starting to kick up a little bit, and people are less likely to hold bonds, so they sell their bonds, which pushes the yields higher. And what that means is yields have to go higher to attract more people to buy bonds. So if everyone's selling, yields are going to go higher, if that makes sense. So next, this is the 30-year, and you can even see it in the 30-year. So the last one was a 10-year, and the 30-year we are going higher. It's moving higher. We have a 50-day crossing the 200-day. It looks like it's going to go higher, and that means that more than likely inflation is here. This is the dollar. This is USD. And you can tell this thing's declining, and we just broke out again and declining further downward. So we have a declining dollar. So I've got one chart here. This is SM Energy, just to show you kind of volumes. This thing sold off quite heavily. And I'm decent at reading technical charts. And what I look for is the volume changes. You can see volume really kicked up through this entire area down here. It means that the buyers are stepping in and they're saying, nope, this decline is ready to be done. We're buying all this stuff. And then somebody's loading up here. And that's what these volumes are. These bars is volume. So this is all volume down here. And you can tell someone's loading up and they push the stock higher. The buyers overwhelm the sellers. But there was still a bunch of sellers in this. So it declined over the summer here and the fall. And then you could see, every once in a while you could see some buyers step in. And there was just a ton of buyers under here. So the way that I look at it is they provide a floor. I'm looking for buyers, I'm looking for volume, I'm looking for price to start to contract, like right here, where you've got a bunch of buyers just holding up this stock basically. Every time it wants to go down, it gets bid back up, gets bid back up, gets bid back up. It's probably me doing it, but I was part of it. But you can tell that this is where I like to buy when I start seeing these volumes, when I start seeing the contraction and all that stuff. It's just another indicator of people are buying the stock. And if you know what you're looking for, you can really start to tell what's going on behind the scenes, just looking at the chart. So the conclusion here is seeing money rotate out of bonds is through the Treasury yields. Money's going to be selling Treasury yields if the rates are going higher. We want to continue to see if the dollar's declining. Now, it doesn't mean that the dollar is just going to go straight down. It's going to have pullbacks. It's going to pull back up. It's going to do that over time. But overall, we're probably going to see a declining dollar, especially in a real estate boom, and especially when commodities are going higher. Obviously, we can watch that commodities prices directly can go higher. That's another signal and validation of our thesis being correct. Volumes in the stocks we own are going higher. You see large candlestick bodies, and you see the volumes kick up. We just saw that in uranium. It means that money is stepping into the sector and buying. It means very good things if you're a holder of uranium companies. It's more validation that our positions are correct. We should see in the future, is my guess, consumer prices go higher as well. You're going to see that things at the grocery store are going to go higher, and you're going to start seeing inflation work its way through the economy. And obviously, we're watching residential real estate, and it's also going higher. So these are the indicators. This is why I talk about all these things. I talk about real estate, and the importance of real estate going higher means you've got more money being loaned into the system. I watch to see if people are selling bonds, because it's a twofold thing here. If they're selling it, that money's going somewhere. And two, it's a vote of confidence if they're selling bonds going into more risk-on assets. So that's twofold there. Then I watch the declining dollar, because that is just another indication that real estate's going higher and that money's working its way through the system. So, and lastly, if you've got a bunch of stocks and you're watching them, is the volume kicking up? Are people acquiring it in mass? If you're seeing a bunch of people acquire something, you're more than likely that company is going to be fine. You can almost tell, like, if the company's going to go bankrupt, you never see that big volume step in. It's like, man, they're done. But if you see a bunch of volume step in, you're like, ooh, they're not going to go bankrupt, because someone knows something, they're doing their analysis, and they're loading up on that stock. And if it's a whole bunch of volume, that means a whole bunch of people are doing it. So more than likely, it's not going to go bankrupt. And even just the fact that the stock price is going to go higher helps the company out as well. So even if they were, maybe the investors pull them out of it. So that's why I'm looking at these indicators. That's why we're doing it. We're looking at money flows and the rotation of money from sector to sector. That's the whole purpose of this. That's what ratios are. That's why I look at these indicators. They tell you multiple things. So when I go over my market updates, now you understand why I'm looking at this and what it means when something is going up or going down. So I just want to make sure everybody understands this. If you like this content, please, click the thumbs up button, subscribe, and thank you for listening. This is Finding Value.